In the hidden corridors of global financial infrastructure, something extraordinary is happening that will reshape the markets as fundamentally as the invention of electricity reshaped industry. Artificial intelligence is not just trading stocks or managing portfolios anymore, it is actually building the infrastructure of next generation financial markets themselves. This transformation is so comprehensive that it extends from the data centers powering trading systems to the distributed ledger networks that will eventually replace traditional market infrastructure. The financial markets of tomorrow are being built right now, powered by artificial intelligence and distributed technology, and understanding this transformation is essential for anyone who wants to comprehend the future. Global artificial intelligence related spending exceeded $1.5 trillion in 2025, driven by large-scale investments in data centers, advanced chips, and generative artificial intelligence deployment across enterprises. Gartner projects that global artificial intelligence spending will exceed $2 trillion in 2026, driven by continued deployment across cloud platforms, enterprise software, and physical infrastructure. This is not technology spending in the traditional sense. This is the physical infrastructure that underpins the next generation of everything trading systems, portfolio management, compliance, settlement, and asset custody. The specialized artificial intelligence trading platform market was valued at approximately $11 to $13 billion in 2024 and grew to an estimated $13 to $15 billion in 2025, with forecasts projecting expansion to between $33 billion and $70 billion by 2030, reflecting a compound annual growth rate of roughly 20%. This explosive growth represents the transition of artificial intelligence from experimentation to core infrastructure. Where AI markets rest, the foundation of next-generation financial markets is semiconductors, the chips that power artificial intelligence systems. Gartner expects spending on artificial intelligence processing semiconductors to rise from $209 billion in 2025 to $268 billion in 2026, highlighting sustained demand for artificial intelligence-optimized chips. At the manufacturing level, wafer fabrication equipment spending is forecast to reach $126 billion by 2026, driven by artificial intelligence applications in logic and memory. This represents a fundamental restructuring of global supply chains. Taiwan, the world's manufacturing hub for advanced semiconductors, has become economically dependent on artificial intelligence demand. In the second quarter of 2025, Taiwan's artificial intelligence related exports to the United States reached roughly 14% of its gross domestic product, reflecting its central position in the production of high-end artificial intelligence chips through firms such as TSMC. When a single technology category represents 14% of a nation's gross domestic product, that technology has become structurally important to the global economy. Physical infrastructure as competitive advantage. The explosion in data center capacity required to support artificial intelligence trading and analysis is staggering. Artificial intelligence expansion significantly increased electricity demand from data centers, with projections showing artificial intelligence data center electricity consumption rising from 176 terawatt hours in 2024 to 325 to 580 terawatt hours by 2028. Implying an estimated compound annual growth rate of roughly 17% to 35%. This represents an extraordinary constraint on artificial intelligence growth. Power availability and grid capacity are becoming binding constraints for artificial intelligence infrastructure expansion. Power utilities themselves are becoming strategic assets. The utilities and grid operators such as Nextra Energy, Duke Energy, Dominion Energy, and Southern Company, which support data center expansion, are beneficiaries of this transition. Intelligence as market infrastructure. By 2025, the emergence of agentic artificial intelligence represents a major leap forward, with these autonomous systems capable of planning, reasoning, and executing multi-step trading strategies with minimal or no human oversight, continuously learning from market feedback, dynamically adjusting risk exposure, and coordinating actions across multiple assets and time horizons to optimize risk-adjusted returns. This represents the transition from artificial intelligence as a tool to artificial intelligence as infrastructure. Rather than traders using artificial intelligence systems to make better decisions, artificial intelligence systems themselves are the market infrastructure. In the realms of global securities, trading, and market infrastructure, artificial intelligence will play a significant role as firms rely more heavily on algorithms for high frequency trading, with systems that track and instantly process disparate datasets required for real-time trading, helping traders anticipate market trends and make transaction decisions more accurately. Artificial intelligence's predictive models and analytics will strengthen market surveillance and compliance monitoring, given the technology's ability to detect anomalies and potential fraud, with the automation of trade execution activities such as settlement and regulatory reporting helping reduce manual errors and operational costs. Reimagining market plumbing. The most profound infrastructure transformation happening right now is the move toward tokenized financial markets. On December 17, 2025, the Depository Trust and Clearing Corporation announced a partnership with Digital Asset Holdings to tokenize a subset of U.S. Treasury securities custodied at its subsidiary, the Depository Trust Company, using Digital Assets Canton Network. This partnership represents Wall Street's ultimate embrace of blockchain technology for core market functions. The Depository Trust Company received a no-action letter from the U.S. Securities and Exchange Commission to offer a new service to tokenize real-world DTC custodied assets in a controlled production environment, with DTC anticipating beginning to roll out the service in the second half of 2026. The no-action letter authorizes DTC to offer a tokenization service for DTC participants and their clients on pre-approved blockchains for 3 years. The partnership between DTCC and the Canton Network will enable a subset of U.S. Treasury securities custodied at DTC to be minted on the Canton Network, working towards a minimum viable product in a controlled production environment during the first half of 2026, with plans to expand the project's size and scope in the months that follow based on client interest. The significance of this development cannot be overstated. The DTCC is the heart of the United States securities system, clearing and settling the vast majority of securities transactions. When the Depository Trust and Clearing Corporation adopts blockchain technology, it signals that privacy-enabled blockchain networks have matured and that institutional-grade risk management capabilities are being integrated directly into these environments, representing an important shift in how regulated financial markets are beginning to adopt on-chain infrastructure. Under the no-action relief, DTC will be able to use smart contracts to optimize transfers or allocations of assets without foregoing the protection and accountability that a central securities depository and registered clearing agency provides. This represents the holy grail of blockchain finance, combining decentralization and programmability with the regulatory oversight and security that institutional investors require. The infrastructure competitive advantage. By 2025, financial platforms shifted from experimentation to execution, prioritizing uptime, resilience, and trust over flashy features, with growth now depending as much on reliable infrastructure as on user experience. This represents a fundamental shift in how financial institutions compete. The advantage no longer belongs to the most innovative traders or the cleverest strategists. It belongs to the institutions that build the most resilient, efficient infrastructure. Interoperability has become essential, with real-time payments, open APIs, and cross-border solutions outpacing closed systems, and platforms that encourage connectivity with banks, payment networks, and digital wallets gaining market share. The emerging markets revolution. The infrastructure transformation happening in developed markets is being replicated at hyper speed in emerging markets, but with a fundamental difference. Emerging markets are not constrained by legacy infrastructure. In Nigeria, the fintech industry grew by 70% in 2024. In Indonesia, digital transactions surged by 226% in 2024, and Egypt's fintech ecosystem experienced a 5.5-fold increase over the last 5 years. The next decade will be shaped by innovators using artificial intelligence to solve real problems in real communities, rather than traditional financial giants, with the future of finance being written in Lagos, Jakarta, Cairo, and Dubai, powered by artificial intelligence-enabled solutions fused with local knowledge. The regulatory infrastructure revolution. Critical to this transformation is the evolution of regulatory frameworks. Governments and regulators worldwide focused more intensely on digital finance infrastructure and oversight in 2025, with major strides made toward a digital euro that works both online and offline, signaling serious public sector engagement with central bank, digital currencies, and digital finance. In 2026, the next generation of financial systems will lean heavily on agentic artificial intelligence, capable of autonomous decision making and execution, with these systems not just assisting bankers and analysts, but acting as operational drivers for everyday tasks like credit decisions, risk monitoring, and compliance reporting. The systemic risk frontier, as financial markets increasingly depend on artificial intelligence infrastructure, a critical question emerges: what happens if the systems fail? Many market observers and academics have been envisioning scenarios involving autonomous artificial intelligence systems that generate and execute trades without human oversight, but market participants are not yet comfortable with this idea, with most participants viewing having human oversight as an essential part of any artificial intelligence-based strategy for regulatory, risk management, liability, and ethical reasons. Tokenized assets turning real-world value like bonds, real estate, or securities into digital tokens will grow significantly, supported by clearer regulatory frameworks. The infrastructure being built today will support an entirely different type of financial market than has ever existed before, one where assets trade 24 hours per day, where settlement happens in seconds rather than days, and where artificial intelligence continuously monitors and optimizes every transaction. The financial markets of the next decade will not be built by the most charismatic traders or the most experienced advisors. They will be built by the institutions that most effectively combine artificial intelligence sophistication with robust infrastructure, regulatory compliance, and security. The transformation happening right now in data centers, semiconductor fabs, and regulatory agencies is building the next generation of financial markets. Those who understand this transformation and position themselves accordingly will thrive in the world these systems create.